All right, there is your closing bell on this Wall Street Wednesday. And markets ending the day to the downside. It has been a wildly fluctuating day. The Dow, again, was down 466 at one point, ends up down 209 points. The S&P and the NASDAQ falling 17 points each. Let's break down the markets. Sean Bonner, Guild CEO, and Paul Schatz, Heritage Capital President. Nice to see you both. Let me start with you, Sean, on a terrific analogy for a Navy man. You said the U.S. economy, based on all the data you're seeing, is headed for a Navy landing. What is that, and what does it mean for the economy?
Well, that's true. We're used to commercial airliners, and a lot of them are Air Force pilots. These nice long runways that can come in nice and easy. But as you can see here on the Navy, we land on aircraft carriers. We have a very short deck. That jet plane has to be slammed down on that deck to patch that arrestor cable. Often it's called a controlled crash. So I think the soft landing scenario for the Fed is more like a Navy landing, right? We're going to slam that thing down on the deck because with the 9.1% inflation rate, they're going to have to keep raising rates here. But it's going to be a landing. It's going to be a little rough, a little bumpy, but I think everyone at the end of the day is going to be okay. So everyone walks away from a Navy landing usually, but it's a little bit uncomfortable when it's going on.
Paul, what do you think when you take a look at the risk of recession, the probability that maybe we could see one, especially with inflation at 9.1%, the pressure now on the Fed to get much more aggressive? How do you see the next couple of months playing out?
Well, if you like volatility and uncertainty, this is clearly your market and your economy. I said coming into the year that there would not be a recession in 2022. I thought we would stave it off until 2023. It's hard to believe, even though employment is probably the most lagging indicator, it's still going to take time to work off creating 370-odd thousand new jobs last month to get to a looser labor market. It's not going to happen overnight. It's certainly not going to happen in July and August. So it's also hard to believe on the other side that inflation rate at 9.1% ends with anything but maybe a mild recession. So I think the next couple of months, markets, on balance, the stock market drifts higher, trading range, nothing really exciting. We wring out some of the volatility, let fundamentals catch up with what we saw in the first half, which was down 25 to 35%. I liken it to 1980. It's a super good model. Volcker came in, rammed on inflation over and over and over again. We had a mild recession in 1980, 2.5 quarters. A lot of sectors didn't feel it. And this seems like a good model for perhaps early 2023.
And Sean, I want to ask you about the added pressure. Obviously, still the fallout from the Russia-Ukraine invasion. What are you watching there in terms of how you expect that to continue to impact markets going forward, and perhaps something that the Fed should be keeping an eye on?
Yeah, well, unfortunately, this Russian invasion, Russian aggression in Ukraine is just incredibly inflationary. Right? It affects commodity prices, mostly energy and food. It's been talked about a lot. Ukraine is referred to as the breadbasket of Europe, producing over 10% of global wheat, 50% of global sunflower oil. A lot of that's offline now. According to NASA, 22% of Ukrainian farmland is now occupied by Russian forces. And the other major issue you're looking at is a blockade in the Black Sea. So all these towns you hear about, Mykolaiv down to Odessa, and the Snake Island, which is famous for their response to the Russian warship, all that's about control of the Black Sea ports, because 99% of Ukrainian commodities are exported through the Black Sea. The only other way to get out of the country would be to travel to the west through Poland by rail, and that's just not a viable channel. So, one, we've got the issues of farmland, being able to actually have the harvests and take those harvests, but then how are we going to export them, right? How's the world going to get them? Because when you take that Ukrainian wheat and soy and sunflower oil offline, it causes major food insecurity issues in other parts of the world, such as the Middle East and Africa. So again, it's really this ripple effect from this kind of big stone being thrown in the pond of a war in Europe that's having consequences, and will continue to put pressure on inflation globally and in the U.S.
And Paul, put more pressure on the Fed. And Raphael Bostic, Atlanta Fed president, making clear everything is on the table. Are we headed for, in 2 weeks from yesterday, a 100-point basis hike?
I don't think it matters, frankly, whether you do 75 or 100. In my view, the economy We came into the year with the economy beginning to weaken. The economy has continued to weaken. Jobs will be last, as I said earlier. I think, it's funny, Bostic is at least the most tactical of people on the FOMC. So if they want to go 100, be my guest, it's just going to hasten us into tougher economic times. And I'll say this, there's absolutely no way, zero chance when they drag Powell before Congress next, if they're losing 50 to 100,000 jobs a month because the Fed tipped us into recession, there's no way the Fed's going to say we're full steam ahead fighting inflation. I give it zero chance. You'll have bipartisan. You don't get bipartisan support very often. You'll have bipartisan support and hatred for what the Fed is doing as constituents are calling their congressmen into an election. So I look for the Fed to pivot later. And let's not also forget, crude oil peaked in March. Home heating oil peaked in May. Gasoline prices peaked in June. Wheat peaked in March, too. All commodity prices in the markets. It takes 6 to 9 months for a lot of these commodity prices to filter through the economy. So as I've told people over and over and over again, help is on the way. You just got to be a little patient, and sometime between now and the end of the year, you're going to get relief.
Paul, I know you're saying it doesn't matter whether they do 75 or 100 basis points, but what do you think the market is anticipating? If we do get that 100-point hike, how do you think the market is going to react?
So, Shauna, you've known this a long time, too. When have you ever seen a market begging for tighter, monetary policy? It flies against everything that we talk about. So I know what people say they want, but really, if you hike 100 basis points now, you may get a quick move in either direction, but it clearly isn't good long term for the market. Certainly not the stock market. I'm encouraged that the action today was okay. I like the fact that bonds shook off some early weakness. So the market is pricing in, tighter monetary policy. And look, if you look far out in the curve, which I know it's like a coin flip. It's like picking the weather for next week. But we're already looking at, rate cuts end of next year into 2024. So, the Fed wants to hike 100. Be my guest. You're just gonna weaken the economy more at a time when you've got a problem in an election coming up soon.
Indeed. Well, that's our market panel. We'll have to leave it there. Guild CEO Sean Bonner and Heritage Capital President Paul Schatz, thank you both so much.